At the very heart of finance, there's this multi-trillion-dollar question that it seems to make no sense at all. But today, we're going to tackle it. We're going to look at this amazing model from researchers Burke and Green that just flips a huge common assumption completely on its head.
So here's the puzzle, right? We see this massive, massive flood of money into mutual funds that just had a killer year. But at the same time, we're told over and over again that past performance is no guarantee of future success. So why do we keep doing it? Are we all just being irrational? Are we making a giant mistake?
I mean, the evidence seems pretty clear. Over the long haul, most of these actively managed funds, they just don't beat the simple, low-cost index funds. You know the story. Last year's hero is often next year's zero. It makes the whole thing feel like a total coin flip.
And that leads to the standard conventional wisdom, which this paper sums up perfectly. Basically, if a fund's great performance doesn't last, it's got to be luck, not skill. The takeaway from most people is that even the best managers out there just can't consistently beat the market.
Okay, but this is where it gets really interesting. What if that whole idea is completely backward? What if the fact that performance doesn't stick around isn't a bug, but actually a feature, a sign that the market is working perfectly? And what if chasing those hot funds isn't a mistake at all?
To wrap our heads around this, the researchers give us this great little thought experiment. We're basically going to build a model of the investment world from scratch, but with one key assumption. Everyone in it is acting rationally, in their own best interest.
It's a simple two-step process. First, we're going to jump into this fantasy world where we know for a fact who the genius fund managers are. Then, we're going to snap right back to our world, the real world, where skill is hidden and we're all just trying to figure it out.
So, let's start with step one. Imagine we all just knew that Manager A was a certified stock-picking genius who could generate amazing returns. In a competitive market, what do you think would happen next?
Yep, you got it. A tidal wave of money would pour into her fund. So much money, in fact, that all the investors rushing in would compete away any potential extra profit. In the end, investors would get a return that's no better than the market average, while the manager gets incredibly rich by collecting fees on that massive pool of assets. All the value from her skill, it goes to her, not the investors.
Okay, time for step two. Let's snap back to reality. In our world, we have no idea who the real geniuses are. The only clue we have, the only thing we can judge them on, is their track record, how they performed in the past.
And in this world full of uncertainty, seeing a manager absolutely crush it with incredible returns, well, that becomes the most rational signal we have that maybe, just maybe, they've got some real skill. It's not a guarantee, obviously, but it's the best data point we've got.
And this brings us right back to our original puzzle, but now we're armed with the tools to actually solve it. So why doesn't great performance last? Well, the answer is all about the powerful engine of competition. Let's just walk through it. Say Fund A has a lights-out year. It beats its benchmark by 15%. I mean, for an investor, that's a huge flashing signal that there might be some real skill there, right?
So what happens? Smart, rational investors see this performance and they do the logical thing. They pile their money into Fund A, hoping to catch some of that magic.
And here is the absolute key. This is the punchline. The fund gets huge with all this new cash, but that very flood of money is what makes it so much harder for the manager to find those amazing opportunities, and it causes those future excess returns to get competed away, driving them right back down to zero.
You know, the economic idea behind this is called decreasing returns to scale. And this chef analogy is just perfect. Think about it. A manager might be a total genius at finding a few hidden gems with a small $10 million fund. But give that same manager $10 billion. It's exponentially harder to put all that money to work without moving the market or running out of good ideas. Skill just doesn't always scale up.
So with this in mind, we have to completely rethink what it means to chase performance. It's not some dumb behavioral mistake. It's not a sign that investors are naive. According to this model, it's the central mechanism that actually makes the market work.
And here it is, the big aha moment. That huge flow of money chasing the hot funds is the very thing that makes the market efficient. It's the force that competes away the future profits, which, in turn, is exactly what makes future performance look so random and unpredictable.
So let's just think through the implications here. Chasing performance, that's just the market's rational way of sniffing out talent and moving money to it. This whole process makes sure that capital flows to where it's supposed to be, and it ensures that, on average, nobody gets a free lunch. So that lack of persistence we started with, it's not a flaw, it's proof that the system is working exactly the way it should.
Now, if we accept this way of looking at the world, it leads to some truly wild conclusions that pretty much challenge everything we thought we knew about the active fund business.
Okay, get ready for this. The researchers took their model and calibrated it with real-world data, looking at fund flows, how long funds survive, all that stuff. And they came up with a number.
That number is 80%. Their model suggests that the vast majority, we're talking 4 out of 5 active managers, actually have enough skill to generate returns that at least cover their fees. The crazy twist? Skill isn't rare at all. It's common. The catch is that investors don't get to keep the rewards from it.
This table just lays it out perfectly. The old way of thinking was that manager skill is basically just luck, and if you find it, you'll get rich as an investor. This new model flips that completely. It says skill is actually pretty common, but investor excess returns are competed down to nothing, and the managers, they're the ones who get rich from the fees they charge.
So, in the end, this model from Burke and Green suggests we've been asking the wrong question the whole time. The real puzzle isn't why don't winning funds keep winning? The much more interesting question is, in a competitive market for talent, who actually gets to profit from that skill? Is it the investor or is it the manager? And this model gives us a very clear, and I have to say, a very provocative answer.